For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
What do you say? Let's manage your financial future. Why not? I'm here. Professor Rick Plum, certified financial planner professional and accredited wealth management advisor, is here. We got the microphones rolling. We've got the tape rolling. I have reel-to-reel tape I'm recording this on, Rick Plum, just so you know. I'm definitely
reel
old school.
to reel.
Yeah, reel-to-reel. Or cassette. I don't know. Maybe you can pick up this show on reel-to-reel, cassette, or 8-track tape, okay? Just not vinyl.
Is it live or is it Memorex?
Yeah, boy, that goes back. Well, this is live to tape, as they used to call it. No, we're using all the modern equipment here. And as a matter of fact, this particular episode, we have not talked about. We've done 250 whatever episodes. We have not talked about today's topic ever, and there have been reasons for that. But we can
regulatory reasons for that.
Oh yeah, that's true. But we can talk about it now, which is wonderful because it's an important thing. The topic, of course, is, if you read the notes on the show, is rollovers. Now, not turnovers, which are delicious, by the way. Apple turnovers, especially. Rollovers. So here's the deal. Okay, you've got a 401k at work, okay, and you leave that employer for whatever reason. It doesn't matter why. What the heck do you do with the 401k from the job that you just left? Now, in most cases, not all, but in most cases, you have a couple of options. You could leave it where it is with your previous employer, or do what's called a rollover, where you roll that money, usually all of it, into your own IRA or whatever. Now, Rick, one of the reasons I wanted to spend time on this today, besides the fact that we haven't talked about it, is because this is one of those decisions that I think feels kind of administrative. You know, you got paperwork, it's forms, there's a box you check when you leave the job, and it kind of feels routine, and you may not be thinking about it. And a lot of people rush through it, or they follow whatever generic advice they might have heard, if they hear anything at all. Now, this is kind of a common thing. People do a rollover sometimes, thinking that they're simplifying things. Only to find out years later that maybe they boxed themselves in, or they didn't do a rollover because they were afraid of doing the wrong thing, and they might have ended up missing opportunities they didn't know that they had. So we're going to talk about this, and I want to emphasize too here at the top, it's not to say that everyone should roll over their 401k, and it's not about saying you shouldn't roll over your 401k. It's just that before you make a decision about what to do with your old 401k or 403b accounts, whatever retirement plan you have at work, you need to understand what your options are. And I know you've said this for years, Rick. You've said that a rollover is never just one decision. It's usually 7 or 8 stacked on top of each other. So,
and it's very individualistic, like everything else in financial planning and financial world.
Right.
There are reasons to and reasons not to do certain things. And transferring money from a 401k to an IRA, there are reasons to and reasons not to do it.
Well, yeah, it goes back to the old, it depends. So I'm going to go to our list. Now, you actually, I think, made this list several years ago. These are 7 factors that you have to consider before making a move with your 401k. And I'll mention this here at the top. I believe we have a downloadable guide that covers these 7 factors. I'll tell you more about that here toward the end of the episode. But I want to get moving on these because we got to get through 7, and we only got 30 whatever minutes to do this. So let's start with the first factor you need to know when you're considering what to do with your 401k. First thing, Rick, would have to be, and not in any order of importance necessarily, but the first thing would be the size of the account. Not every balance gives you the same choices.
Well, and basically, the smaller the account, the less your options are, basically. The reality is, if you've been with your employer a very short time, or you never contributed, and the balance is less than $1,000, most likely that 401k provider is just going to cut you a check. It costs money for the employer per participant to do the record keeping and do everything. So if your account balance is very, very low, they don't want to pay the fee, and they're just going to cash you out. They're going to send you a check. Now, you receive that check. You have the ability to roll it into a traditional IRA if you have one, and avoid the tax on that. Or you can just take the check and cash it in. That is a taxable distribution. And if you're under 59.5, it'll be subject to penalties. Now there will probably, I think it would be a 20% withholding. So, if the balance was $999, under $1,000, you're going to get a check for $799.90 because they're going to withhold 20%. Then you can do what you want with that. To avoid tax on the whole $1,000, you'd have to come out of pocket $200 basically to roll over the whole thing. So under $1,000, not that many people have balances under $1,000 when they leave their employer. Between $1,000 and $7,000, the employer can either take direction from you to roll it to an IRA or another plan, or they can just create an IRA on your behalf and put it into an IRA on your behalf. And it may not be the IRA you want, but that's where it's going to be until you do something else with it. Once the account balance gets to $7,000 or more, the 401k provider, the company that you work for, can't force you to take it or do anything with it. You can just leave it right there. Now, that doesn't should.
In the 401k, you're saying, not
in
as
the
an
401k,
IRA.
401k balance. When you leave the employer, they cannot force you out of it at that rate. That number goes up a little bit from time to time. It was $5,000 for a long time, and that was not that long ago. But so, I mean, when you have these little small account balances, do you really want to have these accounts out there? If you switch jobs a lot, or have and you have these little account balances, you can either roll them into an IRA or you can roll them all into your current employer 401k. Most employers will allow the transfer in of IRA money or for previous employer. Now, when we say 401k, we mean tax-deferred retirement accounts, basically. 401k, 403b. I will leave 457 off to the side for a minute because there's a few different rules for 457s and make them a little bit unique. But when we're talking about the 401k, I'm using it as a generic company-sponsored salary deferral, or some kind of company-sponsored retirement plan, profit-sharing plan, or some kind of retirement plan. And so it's just a matter of what should you do with the account balance?
Right.
Should you leave it there? Should you roll it over?
Yeah.
And a lot of it comes down to the 7 things we're going to talk about in a minute.
Right. So the account balance is one thing. And if you have more than $7,000, and I think if you've been there for more than a couple of years, you probably do if you're a regular contributor. So that's one of the that's kind of the first factor. The second.
Now, I will say that with the smaller the account balance, the most likely you're going to forget about it and lose track of it and forget where it is. I saw a report just the other day. There's 39 trillion. There's a very large number of retirement accounts that are basically floating out there that have been forgotten about. The people don't even know they had them. And that's a decent amount of money that you could use. Don't lose good money.
Yeah, it probably is. So that's the first factor. The second factor you need to consider, besides the size of your account, is your age. And this does apply because it affects things like penalties, access, and strategy.
Well, true. Now, if I have a 401k and I'm under 50, 55, I probably want to make my life simple. So if I have an old 401k, I either want to roll it, most likely, I don't know, to an IRA or to my new company employer plan. If I've terminated employee, though, here's where we get into the age issue. If I'm under 59 and a half, but over 55, I may want to leave the money at the 401k just so that I have access to it. But that, when I say age 55, that means that I terminated employment for that company in the year that I reach age 55 or later. The rule for 59 and a half, that premature 10% penalty distribution rule that's out there from IRAs, that it's 10% from 401ks too, but the definition of premature is not as hard and fast as 59 and a half. It may be 55 if you terminated employment in the year you turn 55 or later. So you may be able to get to the money earlier if you need it for a stopgap until you find your new job or because you wanted to retire early. And if you're a safety member, first responder type person, the rule is 50. You can get to the money without penalty at age 50. You have to be classified that way, though. You can't just make it up. So there is some reason to leave it at the 401k. And a lot of times we will see people that want to retire at 56, 55, 57, whatever in that area. And what they do is they determine how much money they may or may not might need between their retirement date, 55 and or older, and age, call it 60. And they say, well, I need $50,000 a year. So I'm going to leave $200,000 to be able to take out at 56, 57, 58, and 59. And that way I have my income set. I can take it directly from the 401k. The 401k from the employer that I retired from, terminated employment from at 55 or older, and I don't owe a penalty. And then I'll roll the rest of the money over to an IRA where I can invest it with more flexibility and control because they want, if that's a reason. And that way I can have fun with it. But I know that I can get to the money. I don't want to roll the whole thing because then I have a penalty or I got to deal with 72T, structured payments. And this is bringing the other one. This is where 457s come into play. If you worked for a government entity, 457, you could technically roll that to an IRA. But if you're under age 59 and a half, and I'm not going to say 55 here, if you're at any age under 55 and you have a 457, you can access that money after you quit without a penalty. It does not have a penalty.
You said under 55?
Even under 55. Okay. There's no age penalty on a deferred comp.
Yeah, that's a special deal with the 457s.
So that's why I left it out on its side, because it has that one caveat that the age 59 and a half does not apply.
And don't forget,
if you're trying to retire early, or you think you might need to access the funds early, you have that. You want that flexibility. You don't think you're going to need the money, but you want to ensure that you have that flexibility in case you need it. Leave the money at the 457. It's a area that, yes, it will be taxable when it comes out, but it won't be penalized. So
and
we
that's
have to look at when we can access the money.
Yeah, the money will be taxable no matter what, but this is just a question of penalty. And again, on that age 55 rule thing, you have to have left that job in the year you turned age 55 or later. So that you mentioned that. I just want to make sure that's
terminated employment for any reason.
Yeah, it doesn't matter.
Your choice, their choice, with cause, without cause.
Yeah, it doesn't matter. It doesn't matter. Okay, so those are the first two then are factors that you need to consider are the size of the account, as we said, and your age. The third one, and this is kind of a big one, are there any outstanding loans on that particular retirement plan? Because this can turn into something of a taxable event.
Loans are available through many company-sponsored retirement plans, mostly 401ks. And what happens, though, is when you take a loan, and they're not uncommon. I don't think it's a majority of people that have them, but they're not uncommon. When you take a loan, the asset in the account is the loan to you. And so your job is to pay that loan back over a maximum of 5 years. But let's say you take a loan out and then unfortunately have to leave employment, either your choice or their choice. And your account balance is, $7,000 or $8,000. The problem at that point is many 401k providers are not set up to accept payments from you other than through salary deferral. But you're no longer working, and I shouldn't say salary deferral, salary deduction, because it's not deferred. But that's the only way they can take a payment. But if you're not working there, you're not getting a salary. If you're not getting a salary, there's no way they can deduct the payment to the 401k loan from the salary that you're not getting. And once you go past a quarter or 6 months, that loan becomes in default because you haven't made the payments. You have to be making payments to keep it alive. And once it's in default, it becomes a distributable event. And so they just distribute it. And how do they distribute it? They just make it a taxable event. They say, okay, you're not going to pay it back. You owe $8,475 at this point. Boom. We just gave you that loan out as a taxable event. We gave you the money before. You paid back some of it. Now we're going to make it a taxable event. And because you're under 59 and a half, or maybe even under 55, those rules apply, you might have to pay taxes on money that you got 2-3 years ago. Mm-hmm. You don't even have the money anymore. And so you've got to be careful when you have loans. Can you pay it off before you terminate employment? Is your company one of the few that will accept payments after the fact? Not many do. And so loans, if you've got an outstanding loan, be careful about what happens when you terminate employment.
Yeah, and of course, terminating employment is as you said, it may not be your choice, but I think it's something you have to think about when you're taking a 401k loan, that could potentially be an issue. Taxes, of course, and potential penalties. So, but when you're thinking about rolling over and moving that, if you do have an outstanding loan, there's a very good chance that it could be wind up in
default,
taxable. Yeah. People have said, "Well, can I just write a check?" And as you said, though, it's a salary deduction is how this is paid back.
Yeah, but you may be able to write a check. Like the last 401k provider that we worked with in our firm, you couldn't just make periodic payments. The only way you could make payments was through the salary deduction. But if I wanted to pay it off early, they would accept a check for the full balance outstanding.
Okay. Oh,
so it depends on how your 401k is set up.
Well, check with your 401k administrator on that. But this is a factor that you need to consider is outstanding loans. That's the third one. All right, let's move along to the fourth factor here as we consider these 7 factors that you need to consider when you're trying to decide if you should roll over your 401k or not. And that's, I'll say it as investment options and flexibility that you may have. Now, having more choices may be better, but it isn't always, but having fewer choices can sometimes hurt. So explain what we mean by investment options and flexibility.
Well, it depends on how you like to be an investor. 401ks typically have a set number of investments, although today's world, many 401ks have pretty much unlimited, and even some of them have brokerage capabilities where you can make it into a brokerage account and you can do whatever you want, basically almost like day trade if you wanted to. So how much option is too much option? An IRA, you can pretty much do anything you want, within legal bounds. 401ks, you may have limits. But on the other side of that, one of the most popular 401k type plans out there is the federal government's TSP, Thrift Savings Plan. And it basically has 5 options. That's it. It's very simple. Now, I know somebody out there saying, no, we got more than 5 options. We've got life cycle funds and we've got these other funds. Yeah, every one of those funds is a combination of the original, or not the original, but of the core 5. That's all they. So you've got either they're setting the combination up or you're setting the combination up for the 5, GFCSI funds. That's it. They're very inexpensive. It's very easy to manage. So sometimes in our old 401k, we had thousands of choices. And it got down to be kind of a paralysis by analysis. It was like, how do I evaluate and check and look and make sure that I'm doing the right thing when I've got so many choices? And you almost get an overwhelm. Having 5 choices, in some cases, it's just a lot easier. So depending on how you want to look at it, having unlimited choices is either really good or not so good. And having a limited choice maybe not that good, depending upon what your choices are, or maybe just very nice because, like I said, the TSP is most everybody that I know that's in the TSP loves it. The fact that they only have those many choices.
Well, it can be nice too. Now, as far as considering this on the rollover decision, though, time was that the 401k, as you said, you had some limited options. Maybe that's less so now. But if you roll them over into the IRA of your own direction, then you're really kind of on your own, and you have maybe close to unlimited options. You have a lot of flexibility, but it also requires some amount of discipline. I don't know. The reason we have to consider this is why.
Well, because who are you as an investor, and what are you trying to accomplish? Some plans don't allow actually bucketizing. The TSP is guilty of this. When you take a distribution from the plan, they take it from your entire holdings. If you've got 5 funds and you got 20% in each fund, and you want to take out $10,000, they're going to take $2,000 out of each one of the funds.
Yeah.
But what if I don't want to take money out of X fund? I only want to take it out of A fund. And some plans will allow you to dictate which fund it comes out of. Some plans won't allow you. So you can't actually bucketize because they're going to prorate the distribution across all the investments. So You could be selling something when it's down and you don't want to.
Yeah, you could be kind of forced to sell investments at the worst time. So all right, investment options and flexibility. That's something that you need to consider. That's the fourth thing. Now let's move along to the last three factors that we think you need to consider when doing a rollover. And taxes. Well, I mean,
taxes are more from a withholding side. I think because reality is taxes are the same. If I take $10,000 out of my 401k, or if I take $10,000 out of my IRA, assuming no after-tax money anywhere, it's taxable. The $10,000 is taxable either way. Where it is different is tax withholding. Distributions from a 401k have a mandatory 20% tax withholding. What if I'm not in a 20% federal tax bracket? What if I'm in a 10% or 12% federal tax bracket? Well, they'll withhold 20, and then I'll just have to file my tax return to get the other 10 to 8% back later. Or what if I've already satisfied my withholding through other sources, other means? I'll just have to wait until I file my tax return to get my money back. With an IRA, you can be more selective on your withholding, so you can manage your tax liability maybe a little bit better. Now, you can go higher on the 401k, but you can't go lower than 20. And some are just flat 20.
Now, if you have post-tax money in that 401k, as some people
post-tax
do.
money is similar to the post-tax money in an IRA. It's going to be a pro-rata distribution. But if I have post-tax money in my 401k, to me, this is a reason to roll it to an IRA. Mm-hmm. Let's say I have a balance of $300,000-$400,000, and I got $40,000 of after-tax money in my 401k. How that money got there, I don't know. I made some after-tax contributions somewhere. I don't know how it got there, but I got $40,000 of after-tax money. Distributions, $40,000 of after-tax, $400,000 total value. 10% of that distribution will be after-tax if I take a systematic or periodic distribution. If I terminate my participation in the plan and I roll the money over, I could roll $360,000 to a traditional IRA, and I could roll that $40,000 of after-tax money to a Roth IRA. And now I don't have to worry about the proration. I can leave the Roth IRA to grow for future and let it grow tax-free going forward, hopefully. Get my 5 years and 59.5 in, and it'll be tax-free. Mm-hmm. So I have the ability, when I leave the employment, to separate the after-tax and the pre-tax money into Roth and traditional IRAs.
Is this a somewhat new rule? I don't remember that 20 years ago, but I could be wrong.
Well, a little over 20 years ago, we didn't have Roth 401ks.
Well, okay.
But no, we did. We always, back in the day, we used to have more people with after-tax money in their 401ks. And this is something you have to be careful with on the tax side. If you have after-tax money in your 401k, make sure that you do not transfer 100% of the 401k to your IRA.
Right.
Because in that same example, that $400,000 total value, $40,000 after-tax money, I don't have to separate it. I could say I could check the boxes correctly and just say send it all to my traditional IRA. Well, guess what? Now my traditional IRA has $400,000 value and $40,000 of after-tax money, and I cannot separate it ever again. Basically.
Too late.
You're done. You're stuck with the proration
Right.
8606 form forever. The only way to separate it is to get another job and roll just the pre-tax money from the IRA into the new company's 401k once you're eligible to participate, leaving naked the after-tax money and convert it. It's getting to be a pain.
Assuming they even allow that.
Just don't do the first step.
Don't do it. Okay. Now, I know this is starting to get a little wonky here, so I just want to make sure people can understand this. So let's move along to the last two. When I said wonky, these might be somewhat a little bit, but let's try to keep this simple if we can. A lot of people who work for publicly held companies wind up having some of their own company stock in the 401k plan, okay? Now, in some cases, they don't own a lot, or it hasn't appreciated much. But there are others who happen to have a good amount of very highly appreciated stock in their plan. And in that case, they may be able to take advantages of some tax benefits that are offered to them. So just talk for a moment, if you would, about the sixth factor, which is what if you have company stock in your 401k?
Well, a lot of larger companies, if you work for them, they will make the matching contribution in the company stock, or you have the ability to buy company stock within the 401k plan or the profit sharing plan. It could be any type of ERISA-controlled retirement plan that has that employer stock in it. And if you have that company stock in your plan, and if it has gone up in value since the stock went into the plan, So they're looking at what was the value the day the stock entered the plan. Let's say it was $10 a share, the day it entered. And then 20 years later, you retire, and that stock is worth $100 a share because the company has grown, and you've helped, through your hard work and efforts, have made that company significantly better. Now you're retired. You can roll that stock directly to an IRA. You can sell that stock in the 401k and roll the proceeds directly to an IRA. Or you can say, I want to do something called net unrealized depreciation, NUA. I will terminate my employment, my participation in the plan, and I will transfer everything in the 401k except this company stock to my traditional IRA and avoid taxes on all of that money. But this company stock, I paid $10,000 for it over the years, or not. It was worth $10,000 over the years that it was put into the plan. Now it's worth $100,000. Send that $100,000 of company stock to my personal brokerage account. Mm-hmm. Now, normally that would be a distribution of $100,000, but because it's company stock, employer stock for the company I work for, I will pay tax only on what they call the basis, the value when it entered the plan. In this example, $10,000. I pay tax on $10,000, and then when I ultimately sell that stock, that extra 90 or whatever it's worth when I sell it, that's capital gain, and that's a lower tax treatment. And also that $100,000 or whatever it grows to by the time I'm 73 or 75 is no longer in the plan, and is therefore no longer part of the required minimum distribution calculation. Whew. And so it can be very advantageous. Now, it doesn't always work because the depreciation may or may not be there.
Yeah. What you're saying here, though, Rick, in the interest of time, is that because this tax break that you can get on the NUA, it might be more beneficial for you to not roll your company stock into an IRA from the 401k.
Exactly, because we may be missing out on a very nice tax benefit. Now, if the basis is $80,000 and the value is $100,000, there's no real tax benefit there. But when you've got a tax basis in the plan that is significantly less than the current value of that stock, it could make some sense. And it depends on how your company keeps track of everything. But and you don't have to keep all the company stock. Maybe your company stocks. I've seen plans that have $1 million worth of company stock, and they say, well, even at the basis of $300,000-$400,000, I'm not going to take a distribution of $300,000-$400,000. Okay, tailor it, sell off. And tailor the basis to what you're willing to pay tax on. Maybe you take a distribution of $400,000 with a taxable event of $50,000 instead of taking $2 million and $200,000. You can tailor what you want to pay tax on here.
Yeah. Now, okay.
I like control.
Now, we've mentioned NUA, RMDs, IRA. This is like an alphabet soup of options and possibilities here. And I understand it can get complicated quickly, but doing the wrong thing at the wrong time can not only do some damage to your portfolio's rate of return, but it can also trigger some nasty taxes on this, which is why I want to remind people on these decisions, you should work closely with your financial advisor before you make any rollover decisions, okay? Because with your employer-sponsored retirement plan. Just want to mention that. Okay, very quickly.
There are reasons to and reasons not to do rollovers.
Yeah, and that's kind of what we've been saying here. And so far, we've been talking about rollovers for people who've left their employer voluntarily or otherwise. But if you're still working for that company, we don't have a lot of time here, but if you're still working for a company and you'd like to move all or part of your company-sponsored retirement plan into an IRA, there's one more factor for you here, number 7 on our factors to consider, which is what they call the in-service rollover. Rick, can we explain this easily in a short amount of time? Is that possible?
Well, in-service rollover isn't a decision to rollover or not rollover. You've already made the decision. You don't want the choices in your 401k. You want to get the money out of the 401k, but you're unwilling to quit to get the money out because generally you can't move money out of your 401k until you quit work. Once you hit certain milestones, there may be the ability to take some or all the money out of your 401k and roll it to an IRA. It's called an in-service withdrawal. And like I said, this is not a decision to keep the money there or not keep the money. You've already made a decision. You want to move it to an IRA for whatever reason. And if your company allows for in-service withdrawals, you can do those. Generally, the window opens up at 59.5. There may be some earlier windows where you can get some money out of the 401k and roll it to an IRA before 59.5, but generally in-service withdrawals start at 59.5 if your plan allows them. And then you could say, okay, you're still a participant in the plan. You still are contributing to the plan out of every paycheck. But maybe your plan's up to $1 million or more, and you say, you know what, I'd really like to have some different options, or whatever the reason is, you want to roll it to a traditional IRA. If your plan allows for in-service withdrawals, you can move a traditional IRA. Just remember that check your state's liability rules, because 401ks in many states have more liability protection than traditional IRAs. Some states have the same protection. Some states say if it came from a 401k, then we're going to extend that to the IRA. And some states look at IRAs completely different than 401ks, and they're not as creditor exempt. So understand, when you're rolling money from traditional 401k to traditional IRA, the tax liability may be different. And so these are all reasons to look in to keep it or not keep the 401k. One of the biggest reasons that people roll it over is to simplify their life, to make RMDs easier to manage. But you've got to look at all these other factors, including the costs. What's it cost? What are the fees in your 401k? Who's managing your 401k? What are the fees going to be in your IRA? Who's going to be managing your IRA? Are you going to do it? Are you going to have somebody do it? All these things come into play in deciding whether to or not to roll over your 401k to your IRA.
Maybe one of the reasons we hadn't talked about this is because the complicated nature of it and the limited amount of time that we have to talk about all this stuff precluded me from. I realize there's a lot of stuff, here that we talked about. Now, you said your liability. That's in the case, you might have a judgment against you, you get sued or whatever, stuff like that. That's just something else you need to consider. But you're right, Rick. This is a decision that you really need some guidance on, I would say.
Always, because there are good things and bad things to both sides of the equation.
Right, exactly. So you have your plan, your 401k, your 403b, whatever you have at work. We mentioned on this episode the size of your account, your age. Do you have outstanding loans? What are your investment options? What are your tax considerations? Do you have company stock? And of course, we talked about in-service rollover. So this is a lot to consider, and I did want to mention this stuff because this is something that people when they leave their employer, they may have that 401k and they honestly don't know what to do about it, and they never really gave it any thought. You said RMDs. I'm going to keep this very, very quick, but if you had 5 employers because you were moved jobs every 3 or 4 years, and you've got X amount of dollars in each of those, by the time you have to take required minimum distributions, you got to take an RMD from each one of those. It's not like an IRA where you can lump them all. You've got to know where all these accounts are and how much you have.
Required minimum distributions are plan specific. IRAs are one type of plan. Right. 401ks are a overall type of plan, but if you have different employers, each employer's plan is a different plan. Mm-hmm. And each employer's plan has its own required minimum distribution. Taking more money out of plan A doesn't satisfy plan B. IRAs, on the other hand, because they're all considered lumped together, taking more out of IRA A does help satisfy the distribution from IRA B, because they look at it as one big plan. So that's why I said managing RMDs may be easier if it's all in an IRA versus having 401k, 403b, 457, 401a, all these other different types of plans that are out there.
I tell you, it's they would help a lot if eventually they would just make the 401k rules like the IRAs, but they don't do that. So, in the meantime, you got to do this, and as we mentioned before, the tricky part is this: 2 people can make the same rollover move and have very different outcomes depending on their age and their tax situation, their account mix, and what they'll eventually need the money for. So, this is not a one-size-fits-all decision, and these are the kinds of conversations that the advisors at Lucia Capital Group have all the time with their clients. I want to emphasize again that if you are considering doing something with your 401k, and you can certainly leave it in most cases where it is, but if you want to roll it over, you really need some guidance on this. It's not just whether the rollover makes sense, but how it fits into the bigger picture as far as taxes go and RMDs and all that stuff. So if you've left a job, or you're thinking about leaving one, or you're just not sure whether your old 401k still belongs where it is, it's worth having that conversation. You can give the advisors at Lucia Capital Group a call at 800-644-1150, 800-644-1150. Talk to Professor Rick Plum or any of the advisors there, and they'll help you walk through the steps to just figure out if it works for you. You can also visit luciacap.com, LUCIACAP.com. If today's conversation got you thinking about what to do with that old 401k, by the way, we do have a free rollover decision kit, which I believe just put back up onto the site. So this is going to walk you through each of these 7 factors that we talked about today. And hey, if nothing else, it can help you think through your options clearly without rushing into anything. So if you just type rollover into the search bar at luciacap.com, it should come up and you should be able to download it and just look at it, consider it. It discusses a lot of the things that we talked about on this particular episode. Don't forget, we got other guides up there: Social Security, estate planning, taxes, bucket strategy, and all that stuff. Just download it and take your time going through it. All right. As always, make sure you subscribe to the podcast, Apple Podcasts or Spotify. Don't miss an episode. You'll walk away, I think, with a better understanding of the decisions you're facing, and sometimes that clarity alone makes all the difference. Professor, I thank you for this. I know this was more complicated than I thought, but you did pretty well in taking this complicated topic.
Well, thank you. Thank you, sir.
I hope so. And if you have questions on this, please let us know. My thanks, as always, to Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. I'm your podcast host, Johnny Dean. This is Managing Your Financial Future. Thanks for listening. We'll talk to you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Stock investing includes risks, including fluctuating prices and loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options. 1. Leave the money in their former employer's plan if permitted. 2. Roll over the assets to their new employer's plan if one is available and rollovers are permitted. 3. Roll over to an IRA. Or 4. Cash out the account value. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Distributions of principal from a Roth 401k are tax-free. Any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth 401k was established, whichever is longer. Your investment options are limited with the Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.